Welcome to the Boomers, Bucks, and Bling podcast, where we turn retirement planning into a bit of a thrill ride. I'm your host, Carl Spiteri, and each week we'll dive into everything from reverse mortgages and staying put in style to Medicare, Social Security, and home safety. But wait, there's more. We're not just going to talk all about money and business. We're going to add some sparkle, some bling, as we chat with travel pros, party planners, and a lot of different topics that's going to help you make the most of your golden years. So grab a cup of tea or whatever it is you want to drink, get comfy, and let's make retirement planning an adventure of a lifetime. Hi, everybody. Carl Spiteri with Boomers, Bucks, and Bling. This is our latest episode. We have Gina Roman from Roman Insurance, who's going to give us some really interesting information. We met, we had a conversation about 2 weeks ago, and I was amazed at some of the things going on in the insurance industry. So I think she's going to be real helpful to y'all. Gina, why don't you tell us a little bit about yourself and your company?
Sure. I've been an independent insurance agent for about 20 years. I started only doing California properties, but I have expanded out through most of the West. My primary focus has been on personal lines, so that would be like home and auto, but I also help people with their small businesses as well. I got into this business primarily as a way to support my family and being able to be at home raising my kids. Well, now my kids are grown,
I don't
and
need you anymore.
yeah, they don't need me anymore. I'm out. I'm old news, and but I really love what I've built, and I love the relationships that I've formed, and I see myself doing this for another decade at least.
Okay, perfect. Well, why don't you tell us a little bit about just a big picture, right? We'll bring it in as we move forward. But big picture, what's going on with the insurance industry in general, and then specifically in California?
Well, specifically to California, we'll kind of circle back to, but um, inflation has kind of been the word that people have been talking about in the economy now for a few years. And I know that there was a lot of uncertainty during COVID. There was a lot of businesses that were kind of in flux. Revenues were a little peculiar those years. And then as a response to it, the lag effect has now been that we are all seeing as consumers just pricing that has just kind of crept up. And as pricing creeps up in tangible items and in services, obviously the insurance companies on the whole have to respond. So whether it's significant losses on the East Coast because of hurricanes or whether it's fires in California, there's this one great big pot of insurance that has to get distributed across all of it. So especially those bigger names that people are very familiar with, they have to handle coast to coast. So even though there may not be a crisis in the middle, there are definitely events on both sides of the United States that are driving insurance premiums up as the losses become more significant. So the response has been to raise prices, which doesn't really leave the consumer feeling very taken care of. But we're trying to find some new solutions. I mean, this all kind of, they're trying to segment things out to just say West Coast stuff is going to be a California problem and Florida's problem is going to remain a Florida problem instead of trickling out to everybody in the country. That's been one solution. But of course, then that leaves insurance companies looking at their bottom line and wanting to ever tick up the premiums to reflect, what they're paying out in the form of claims.
So we're in California, even though we both do business in other states, but we'll kind of focus on California here. So I've heard of this insurance called the California Fair Plan. So
Sure.
tell us a little about the positives and the negatives of the California Fair Plan.
Sure. Increasingly, obviously, we've heard at least for a decade about the risk of brush. That was kind of the buzzword for the last 10 years, is that with these wildfires and areas that are heavily impacted by vegetation or surrounded by vegetation, there's just an increased risk for fire in those locations. And as we've seen over the years, the fires have been devastating. The Paradise Fire from a few years ago completely eliminated an entire town. We saw these fires in LA do so much damage that they still haven't even, as of what are we at? We're at April of 2025. They still don't have a dollar amount that they can assess to it, but it's gonna be really deep. It's gonna be deep. So, all of your insurance carriers, they look at their most significant losses. And as you could assume, a fire loss is going to be more significant than an internal water damage claim inside of a house. So,
Right.
insurance companies, little by little, started pushing back against the insurance commissioner in California. And they wanted either to A, raise the premiums so high that it would be almost prohibitively expensive for homeowners to be able to carry it, or they wanted the state to come up with a solution to offset the insurance company's risk. So the California Fair Plan came about as kind of a last solution, or that final thing that there's nobody else that will take this risk because of the fire or because of the way the brush is set up around a home or the location. And little by little, more insurance companies started to lean on the California Fair Plan to keep their base premiums reasonable, which consumers like. But then they kind of get tossed into this bin of the California Fair Plan for fire coverage. And should there be a fire loss, you can imagine that there's only one solution. There's one, and it's a state-run option. So the immediate con is that the immediate negative impulse that a lot of people feel is that some state-run options are not as efficient, as quick, as responsive. Customer service isn't there because it feels a little bureaucratic. And if you ever have to make a phone call into the California Fair Plan, it really feels like you're calling the DMV. There's not a whole lot of customer care. There's there's not a lot of love. I'm sure that they're fine people, but it's it's the system. The system is kind of designed to be a catch-all net, and there's no urgency because they know that it is kind of like your last resort.
So
So
you don't have the neighborhood, give me a call, let me take care of all this for you. You're calling an 800 number or whatever it happens to be,
yeah, well,
and you're just sitting on hold and going through that whole process.
that's fairly typical. Obviously, when there are natural disasters or there's big fires, they pull people in as support, but they lack in experience, they lack in training, and so again, the consumer feels frustrated. So having an agent, whether they're a captive agent or an independent agent, having that go between is probably the most important thing if you're experiencing such a loss. I mean, if we're
Okay,
talking about a fire loss, that's devastating. So,
so a couple things. You
mhm.
said captive agent versus independent agent. Give me an example, because you
um,
know the industry, we don't, right?
sure. A State Farm agent can only sell State Farm products. That's all that they are allowed to sell. And currently, State Farm is the largest carrier in the state of California. They hold almost 35% of the business for residential homes in California. And most companies would think that having that kind of market share would be great news. That would just make it seem like you've got 35% of the state. That's
I'd
pretty
love
good.
it if I had 35% of
I
all the
would love
mortgage
it. I would
business in
love it.
the world. Yeah.
I would love it. However, they looked at their loss ratio, which is what they were spending versus what they were taking in, and the balance was not there. So that State Farm agent can't go out and sell another brand name. They can only sell their State Farm product. They can't sell a Mercury, they can't sell a Travelers, they can't sell Nationwide, they can't sell Progressive, they can't sell Liberty Mutual. These are all brands that people are fairly familiar with. But when you're captive, you are tied to one and only possible line of business versus being an agent or a broker that's independent. An independent agent can look at what is available in the state and select and choose what is best for the client in that particular house. I don't have to cram a one size fits all into one single product. I can look and find what works best in this county or this county. So when you have that independent agent, they're going to be a better selection for you. Well, and captive agents do a phenomenal job also, but independent agents have just a little bit more variety, and they typically can get through to the California Fair Plan faster than you, Carl. So I have a little bit of a
You have
back
a hotline,
line. I have a few secret weapons. I have a few relationships that I've built that I can more readily access answers to questions, especially when it is a stressful situation like a fire loss. It's it is handy to have that weapon in your tool belt that you can pull out and be able to expedite things a little bit more quickly. So that would be the difference between the captive and the independent agent. There are captive agents that have access to the California Fair Plan. Some of them do, some of them don't. It depends on who you're working with. But the California Fair Plan is accessible with or without an agent. And I obviously would recommend having an agent just to help navigate coverages. But if you're a do-it-yourselfer, you can definitely do it yourself. That would be okay too.
So it's just covering in case of fire.
That's all they
Correct.
cover is fire. So if you have a
Interior,
water,
exterior, the whole thing, or
the whole thing. So they
okay.
would cover whether it was lightning. They call it an act of mischief, which could be like fireworks. That's a good example of it. Or somebody like mixing chemicals that they shouldn't be mixing. How about that? And there's an explosion. Let's say it's your neighbor, and you have an adventurous neighbor, and there's some kind of anything that's a fire, whether it's a candle that got knocked over in the home or an electrical fire from the inside. The California Fair Plan only covers fire, only. So no
So
remediation, no water damage, no liability claims, no dog bites. Nothing like that. Just anything that has to do with fire. It's got to have a fire or
so
smoke.
you're forced to carry now two policies to get what we consider full coverage.
Correct. So that comprehensive policy of yesteryear that we're all very familiar with and we hope comes back very soon. We have a few options that will still do the comprehensive traditional homeowners policy, and that's obviously everybody's first choice. You're going to get much better service. You're going to get much better pricing. You have much better control over your policy if you have that traditional comprehensive full coverage policy. But again, little by little, our carriers that are available in California are relying on that two policy solution that you just kind of discussed, where it's you have something for your interior, your water damage, your liability, your dog bites, all of that stuff is on one policy. And then your fire policy is covering by the California Fair Plan, just anything to have to do with fire.
How does deductibles work? Are they pretty much traditional, or is there
More and more what we're seeing is if somebody has to have that two policy solution, typically they're going to their highest deductible, which is $20,000. And it sounds like a huge number, but when you're talking about a catastrophic loss, most homes in the state of California to rebuild are going to be north of 500,000 to rebuild. Some of them are going to be north of a couple million, depending on where you are.
yeah,
But
$500 to $700 a square foot probably is what the going rate is.
I wouldn't recommend anything much less than 350, to be honest with you. But yes, closer to 400, 450, 500 a square foot to rebuild is fairly typical. And again, depending on how many homes in your area have been impacted, labor and materials are going to be on the higher end. So having that available, having that adequate coverage helps, making sure that you have that. But having that high deductible is actually not as problematic because you're talking about a total loss. You're talking about a small percentage of your, let's just say it's a $500,000 rebuild. $20,000 is not going to make that big of a difference. So I mean, if you typically have always had like a $2,500 deductible, $1,000 deductible, somewhere in there, hearing the $20,000 deductible is more
like, oh my goodness,
yeah, it's more of a mental thing. But to be honest with you, in that situation, you're talking about a devastating loss. You're probably going to be out of your home for a very, very long time. You're going to be up in a hotel or an Airbnb while the reconstruction is going on. Reconstruction might take a year. It might take two. I mean, some of the stuff that's happened in the Palisades may not even get rebuilt. So there are some strategies there that I will talk to anyone about, because if they are more accustomed to having that little deductible, that comfortable $5,000 or less deductible, it's just not that relevant when you're talking about a fire loss. Even if you just have a kitchen fire, it's very, very rare that you're going to have, any fire damage that's going to be less than a couple $100,000. So at that point, even if it's $200,000 loss, we're talking about a 10% possible deductible with that $20,000. I mean, and that's as far as they go. They don't go further than 20,000 for the California Fair Plan. That's as high as they'll go. They'll go
Okay.
down to 500, but the premiums on that are kind of ridiculous, to be honest with you. They really um, encourage with their premium selection. They really
Mm-hmm.
want you on the higher end of your deductible. They don't want little ticky-tacky claims. So they're really there for that catastrophic event. They're not really there for small things.
Okay. So, so I had a client reach out to me about a month ago now, panicked, right? His premium, and those of you listening may think this is not a real story. This is a real story. His and the numbers are off a little bit, but they're because I don't remember exact numbers, but they're close. His policy went from about $1,700 a year to $26,000 a year.
Mm-hmm.
And I mean, he texted me at 8 o'clock at night saying, "Can you please call me back?"
Sure.
So I'm talking to this guy at 8 o'clock at night, going, "I don't know, send me everything." Um, so what does somebody do in a situation like that?
Well, that is a insurance company's friendly way of saying we don't want your business anymore. The
I would
California
bet.
California commissioner will not allow people to be dropped without cause. So if a carrier, ABC Insurance, has too many homes on one street, and again, we're talking about market share. So let's say that there's 10 homes on the street and there was a really productive agent that had 5 of those homes. That's 50% market share on a 10
In
home
the good
street.
old days, like 2019, you
Right.
wanted as many people on this block as you could
Sure.
get, right?
Sure.
Okay,
Isn't that the point of advertising? Like you don't
that's
run
it.
all those ads because you don't want customers. But if you look at that street as an actuary, and again, these are the nerds, these are not the salespeople, these are the people that are just crunching numbers trying to make sure that everything is profitable. It's not the friendly salesperson.
They had
It's certainly,
the pens in their pocket and the little
yeah,
visor on, right? Those
yeah,
guys,
they don't
yeah.
have like they're not doing the cool jingle. In fact, they're the opposite. They're like the fun crushers because they look at it and say, we need to offload 2 of these 5 clients, and they've done nothing wrong. And there's nothing wrong with their roof, and there's nothing wrong with their sidewalk, and there's nothing wrong with their claims. But we can't risk losing all 5 of these houses on the street. So what they do is they make an offer that you have to refuse. It's the opposite of the Godfather. They have to go a completely different direction. They have to make it so price prohibitive that they encourage you without saying you're canceled. They encourage you to shop. Now, if you're willing to pay that $25,000 increase, I guess that they would probably be happy to have you. Um,
Imagine, yeah.
at that point, it's worth it for them. But for the most part, they definitely know that you're going to shop, you're going to make some phone calls, you're going to see what else is available. And in that particular situation, that person might split into the California Fair Plan and a primary policy. That might become a 2 policy client because of the situation. I'm just because of that capacity on that street. There just
Yeah,
might
that
not
is what
be.
this client ended up doing, is going with the 2 policy solution.
You
I will
have to.
say a word of caution. Even though my client said this caught him absolutely by surprise, he did get a notice from his lender, a notice from his insurance company, and a phone call from his agent, which he
Good.
neglected to pay attention to. In
Hmm.
further research, he thought nobody contacted him, and yes, he did get notifications. So pay
Right.
attention to stuff when you get in the mail. I know a lot of times we get tired of sorting through junk mail, but it's kind of important that you catch this stuff.
I would say more and more insurance companies are sending out small notifications that require action. So I would definitely like to follow up on what you just said, Carl, and just reinforce that if you get a notification from your insurance company that asks you to replace a tile on your roof and take a picture of it, please replace the tile on your roof and take a picture of it and send it back to the insurance company. Because if they have cause, if they have put you on notice, now they can absolutely cancel you if you are unresponsive. So for the longest time, people didn't have to open up their mail so diligently, obviously. It's just, here's something from my insurance company. Is probably boring. Probably is boring, but there might be something in there that is worth responding to. So
Okay,
that
so
that
you
that's important.
So you mentioned roof, right?
Mm.
So what other things can insurance companies send you a letter and say, please correct the following?
So more and more, and this, whether people have different opinions on this, but more and more insurance carriers are using drones to scope out your property. And
Amazing.
I don't know that again, like I said, this is a little bit controversial, but they are finding that what they are discovering, besides broken tiles on roofs or solar panels that are not attached correctly or safely, they're looking for trees. They're looking for tree branches that are falling over onto the roof or that are kind of encroaching on the actual structures. So if you have like a separate garage or even like a separate greenhouse, which I mean should feel like a patio item, anything that looks like there could be branches that are encroaching on a structure, they do not like that. Um, Also, sometimes depending on the landscaping, more and more I've actually started seeing like bougainvilleas, which are obviously beautiful, and especially in Southern California, they look great on homes, but they don't really like anything that's bushy with leaves just being so close to the home. And I've seen a couple of requests to remove like beautiful plants, but the insurance companies see it as a risk.
And it's not a choice. It's a, here's what we'd like for you to do. And if you don't do it, we're dropping you.
Well, it's blackmail. Like you're either going to do it or you're not. So if you choose not to, then you have to find a new carrier, which is fine. But
Okay.
the inspectors are kind of picking up on the same thing. So I see a lot of tripping hazards. That would be like a broken sidewalk that's maybe got like different elevations. They're looking at tripping hazards as a problem. And that's not as easily seen with a drone, but it can be. Any kind of weird rigged electricity. I've met some incredibly creative men that have done phenomenal rigging of systems for their backyard to have cool lighting. And sometimes it's really obviously not to code. And if that is spotted, sometimes that's asked again, required to be removed. And then you have to take some pictures and send those back. But I would say that those are vegetation, tripping hazards, wires. Those are probably the most common things that I'm seeing come back as please fix by, and they usually give you about 30 days. You can't obviously replace an entire roof in 30 days, but if you have those old roofs, especially if it's shake, I haven't seen one of those in a long time, but
Yeah.
those are real tough, real tough. Those are difficult.
And not inexpensive to replace either.
No, no,
Roofing
no,
costs
sure,
are great. Well,
sure.
so my client with this, who got the surprise, ended up with a $200 per month increase in his premium to go with the California Fair Plan and a different plan. Again, not to plug what I do with reverse mortgages, but that is a reason to have a home equity conversion mortgage. So you have the money set aside that you can pull from your home if you need to, if you don't have the other resources. So just, I wanted to throw that in there because there is a reason we do these podcasts, and there is a reason I truly believe in the
Yeah.
reverse mortgage. So I just wanted to kind of mention that. Even
I
if you
would
don't
say that,
use it, it's there.
that's super smart to have as a resource, just because this is one of those unexpected but also unavoidable bills. This is not something that you can say that I can just go without. So in your client's situation, unfortunately, there's no choice. Even though I mean, it's not the $26,000 problem, but
Right.
still, it's an
He's
increase.
relieved, but at the same time, he's got to come up with another $200 a month to make us just for
That's
insurance. It doesn't
yeah,
get him
just
anything
just
more.
the basic math on that, your client is describing that 50% increase that a lot of people got. So he went from 1,700, and so now I'm guessing he's more in the $3,000 range. There are so many people experiencing that, and because their premiums hadn't changed for so long, completely unexpected, just
Yeah.
completely unexpected.
Yeah. I know in our mortgage calculations, we use 0.15% on a condo and 0.22% on a house for, I mean, been this business a very, very long time, and we've always used those numbers, and we've just doubled them over the past
Right.
12 months because we were way off on our estimates.
I would say I'm really glad you brought up condos, because even though condos don't pose any additional threat or there's no additional risk, they have become one of the tougher things to insure. Um, they, I mean, for 20 years, they were $500 a year, almost universally. I could tell
Mhm.
you, most condos were, I mean, certainly not more than 1,000,
Yeah,
500 to
always.
1,000, and it was like clockwork. I could do it in my sleep. I didn't have to think about it. And then one by one, the carriers started pulling away from the condos. And unlike the traditional homes, it was not because of the fires. It was because of all the water claims. And the water claims inside of a condo unit can be multi-unit, obviously. Your condo can drip or bleed into another condo. So not only is the insurance company on the line for your losses, but they might be on the line for other people's losses. And that small $500 a year premium wasn't cutting it anymore compared to all
Yeah.
these water losses. Because water loss, I mean, water loss, and especially because those typically had very low deductibles, Carl. For the longest time, I never saw a deductible over $1,000. Just never saw it.
Right.
And
Right.
now I don't see anything less than 2,500. So again, the insurance companies are signaling to the consumer, A, they don't want these little claims. They don't want you claiming every little thing. And obviously, I would assume that most people know that the more claims you have, the more expensive next year's premium will be, or the years to come. Um, Two claims used to mean that it was very difficult to get insurance. And I would say that that's probably still true, but now more than anything, it's location. What are they trying to insure? And those condos have just really been a killer for the insurance companies over the last couple of years. So even though there's to me, I don't really think about it as additional risk. That's one of the things that has kind of come to light is that, especially because condos are great, A, they're great investment properties, and B, they're sometimes what people can afford in California as like their
Right.
starter home.
The kind of the lower end of the spectrum. Yeah. Yeah.
I mean, it's one of the solutions. And insurance used to be so easy. And now I'm seeing that insurance might be the thing that prevents somebody from qualifying for their loan because they didn't anticipate, as you've correctly made that adjustment. A lot of people haven't really mentally come to terms with the fact that a condo is probably twice as expensive as it was even just 2 years ago. So um, that's something to just kind of consider, especially if for the investors. I know that they have their P&L, they have their profit and loss. They look at it and they're like, this sudden increase in the expense almost, it changes what your profits are going to be for the year. So I've had a few investors that are a little bit disappointed, obviously,
Mhm.
about that, but I don't see that changing. I don't see that reversing. I don't see that coming back. I don't see that this is the new normal on condos as far as I can tell. And I would love for more competition to come back into California because the three largest condo insurers quit California. So if you were grandfathered in, you were fine. But if you thought that you were gonna, parlay that into a new property, they're not moving it. So if you
So
lose it,
when you're insuring a condo, essentially there's two policies that you need in a condo. One is for I believe it's called the HO6 policy, which is the interior content of the condo. And
Mhm.
then the association has the master policy.
Correct.
And what we've run into a couple of times over the past few months is where the liability levels of the master policy are so low that they haven't met the requirement, and they're having to up those values and then assess the homeowners
Yeah.
in the association because there's a significant jump in the cost. So it's something else to kind of be concerned with.
That would be, I think that again, the excited buyer sometimes, factors in that HOA fee each month. They're thinking that it's not going to move, but I also in the last 2 years have seen huge problems with the HOA master policy. Some of them, again, here we go. Some of it is a fire risk. When you have these big buildings that are uninsurable by your big names, they have to turn to the California Fair Plan. And the California Fair Plan to cover the fire on it is more expensive. And there you go. There's your special assessment. So whether it's liability or exterior structure coverage, that HOA master policy, that can be in flux, and that's definitely going to modify your HOA fees each month. So it's also something to consider, for sure. That walls in policy is what you're talking about. Some people call it the HO6. Some people don't know exactly what it's called, but the HO6 is correct.
Okay,
And
good. I got
you've
that one
got it.
right.
Yay. You did it. You get a star. But walls in coverage just means that anything that happens on the inside of the property is going to be covered by this policy. So, and again, by the very nature of what I'm saying, that's typically going to be a water loss. I mean, if you're talking about walls in, you're mostly talking about plumbing. You're talking about plumbing and liability. There's not too much outside of that that your insurance needs to worry about. And plumbing leads to water, water leads to possibly mold remediation. All of that's really talking about the same thing.
Yeah.
It's just how bad does it get? That's really where it's at.
Okay. Well, what else do you think we need to know about insurance? I'll kind of open it up to you because you are obviously, you know what the heck you're talking about.
Sure.
Uh, Tell us something else we need to know. I'll wrap
Um,
this up for you.
well, one thing that people aren't necessarily aware of is that homeowners and auto insurance are tied together in the same personal lines pool of business for insurance companies. And most people don't think about their driving or their car having any impact on their home prices. For the longest time, we've all heard about bundling. If you bundle, you can save. They've done a phenomenal job getting that messaging out. um, but unfortunately, once again, bundles are not really available right now. And yet they're drawing from the same pool of money for auto and for home. So I would just
So
say
it
that,
doesn't matter. You're telling us it doesn't matter to have your car and your house insured because it used to save you a bunch of money,
correct,
right? It no
correct.
longer.
Well, they used to be able to apply that multi-policy discount, and that's really what the bundling was about. But
Mhm.
again, we're talking about market share and how
They
much
don't want it.
market
Yeah.
share. They don't want it anymore, but they're running the same commercials. So I like it that they just stuck with the messaging and they're hoping this is all going to turn around. And I love all that advertising. It just generates some interesting questions because it really does mislead the consumer to think that there's these better options that are available. And sometimes there's just not, despite the advertisement. Um, California is in the middle of currently, again, we're mid-April 2025. There's about a 20% increase anticipated across all personal insurance in California for
No
this
matter
year.
who you're with, no matter who you are,
Yes.
count on a 20% premium
Yes.
increase this
And if
year.
it's less, great. Go have a
Yeah.
celebratory
Go buy
cocktail.
yourself a beer. Yeah.
Correct. And that's great. Anything more than 20%, like your one story previously, that is typically an indication that they want to let you go. They just don't have the heart to break up with you. That's kind of like they sent in somebody else to break up for you. This is their way of telling you. Anything more than 20%, it's worth reaching out to an agent just to see. I would call your primary agent first and just see if there's any other options. But more than 20% is an indication that they are looking to let you go. So if you get 25% this year and you say, I'm going to suck it up, expect another one next year. They're trying to nudge you out. That doesn't mean that you have to find something else, just they're trying to nudge you out. That's really the only way that I can put it. And since the two things are tied together, California's minimum requirements for auto insurance also went up this year. We hadn't seen a minimum increase in California in more than 20 years. And of course,
So
that's, go ahead.
slow down on that. So
Mhm.
what went up exactly? Because now
So
all
the
of a sudden
minimum,
all my homeowners insurance stuff's going up. Now the
yes.
state of California comes in and says what as far as
So if you go to the DMV and you want to register your car in California, you have to have California insurance. And you
absolutely.
had to have a minimum level of insurance in order to drive in California. And each state is a little bit different about what those minimums are. And the minimums forever in California were $15,000 per person, 30,000 for the occurrence for bodily injury, and only $5,000 was ever required for property damage. You can't even replace a bumper right now for $5,000 because there's cameras, there's sensors, there's computer chips, there's so much more detail that goes into a small fender bender that $5,000 just wasn't cutting it anymore. And people were finding themselves in court or in lawsuit or in litigation because those losses always exceeded those minimum values. So California doubled it. They took everything and they said, let's bring it up. We'll bring up the injury. I think they brought up the property damage to a minimum of 15,000, which is not terrific. Now, obviously not adequate coverage for somebody that owns a home. I would tell them that they would need, stronger limits to protect themselves on that. But for the number of drivers that exist in California that probably should not be driving because they don't have a legal reason to be driving, it really increases the rates for people that are trying to do things correctly, honestly, and legally. And that's really where we're at, is that there are, again, claims that are being covered because there are people of questionable status driving that should not be statused as drivers. They really don't have to carry insurance. They're not even driving legally. That leaves a big pool of people open to be in an accident with people that don't have insurance. And what does that do to you, the consumer? The consumer is going to wind up paying those claims one way or another. So again, expect an increase because we're covering more of people who don't carry insurance to begin with. And that's also a problem in California. It doesn't get as much. I mean, the fires are always kind of grand.
Yeah, but, right, exactly.
And they make the news, but the number of claims that go uncovered or default back to you, even if it's not your fault, is just way too high in this state. So insurance companies are making adjustments to your bill. So like I said, 20% is basically what everybody should expect.
So when it comes to being mad at somebody, you shouldn't really be mad at your insurance company. They're kind of trying to cover their cost and stay in the black, right?
Right.
But the California Insurance Commissioner is the one who regulates the insurance, right?
Well, he is in charge, and he's had a rough couple of years. I will say that. I try to stay non-political, but yes, he is in charge of approving and facilitating the way rates are distributed fairly. So in order to be fair, this is subjective, in trying to shield consumers from greedy insurance companies, what he wound up doing was chasing insurance companies away. And that shrunk the competition in California. And with such few choices, they can charge more. So we need more competition. I mean, I'm not trying to preach my economics to anybody, but we do definitely need more insurance companies to come back to California that are willing to pick up the risk and spread it out. That would help out a ton. But for the rest of this year, there doesn't seem to be too many things that have been approved other than the small increase. And I say small, 20% is still a significant amount, but it's one step in the right direction to encourage more insurance companies to come back. So if anybody's wondering why the commissioner would allow the 20% increase, is that's going to be a little bit of bait for more insurance companies to come back to California, which we need.
Well, we could go on here for a long, long time, but I think we're going to kind of bring it to a close here. But I tell you, this message, we try to gear these messages to baby boomers. But this is a message for anybody you know. So if you're listening to this podcast and you have some millennials that are just buying their first home or some Gen X, or this is a message a lot of people should hear. Gina, why don't you tell our audience how to get a hold of you? Because you obviously are a wealth of knowledge and you've been in the business a long time. So if people want to contact you, how do they do it?
The best way to find me is if you search for Gina Roman Insurance, you will find me very easily. The website is romaninsurancesolutions.com. Super easy to find. You can reach out to me anytime.
I can't thank you enough for your time and your brilliance here. I know you're going to help a lot of people that listen to our podcast, and just thank you again. We really appreciate it.
Please reach out with questions anytime. It's going to be a moving target for this year, but thank you so much, Carl. I hope you have a good rest of your day.
Thanks. Thanks for tuning in to this episode of Boomers, Bucks, and Bling. We hope we've managed to mix a little enlightenment along with fun. If you enjoyed our conversation, don't forget to hit the subscribe button so you'll never miss out. And if you got a moment, drop us a review. It helps spread the word and keeps us motivated to continue. Got burning questions? Hot topics you want us to dive into? Let us know on our website or social media. Until next time, Carl Spiteri here to remind you to tackle retirement with a big smile and a whole lot of energy.